As we end the show, let's also leave you with the Dipen of HDFC Securities and how he sees markets shaping up in somewhat 2075 and those specific stocks and sectors that he prefers.
So the glamorous answer to this would be that I know exactly when to buy and I know exactly when to sell.
Right.
And that's only a glamorous answer that will get you a lot of sound bites and more viewership. But it's a complete lie. It's a complete lie. Nobody can time the markets perfectly. The point is this, that we are in a compounding market. We are in a steadily compounding market, or in a steadily compounding economy. But the markets do not compound steadily. The markets chase the economy or get beaten down by sentiment. So right now they're getting beaten down by sentiment. There will be a point of time when the markets will not reflect what the economy is doing. And I suppose we are getting into that zone between now and the next 6 or 12 months.
Okay.
We could be in that zone, and that's the time to really accumulate equities for the long run, not for targeting a nifty outcome of 11,000 or 11,500. Anybody who should be buying nifty stocks today at 10,000 or thereabouts should be buying these stocks with a view of 15,000 on the nifty. Whether it will take 2 years or 5 years is anybody's guess, but we are going to get there. I'm very confident we'll get to 15,000 on the nifty, and maybe you'll call me again for a discussion on this. It may not happen in 6 months or a year, maybe even 2 years, but that's not what I'm worried about. I'm confident we will hit 15,000 and indeed probably in my lifetime even 20,000, but that's not the point. The point is that we are going to move forward as an economy. You need to stay invested, and the best time to get in when nobody believes that it's the time to get in. You remember the thing that Mr. Buffett says about greed and fear. So you need to get greedy when everybody else is fearful.
Right. Right, and that is the Diwali answer for the show from Mr. Sheth, saying 15,000 on the Nifty, and not in the next 6 months or a year, but he's definitely looking at over 2 to 3 years. Mr. Sheth, now that we are in this festive mood, why don't you before we end the show, give our viewers a few of these Diwali gifts, so to say.
So I'll have to refer to my cheat sheet there to be more confident.
So any ideas that you can share with us which would be good for capital preservation as well?
Right. So like I said, there are 2 ways you can play this market, and if you're beginning to invest in equities, you're the luckiest guy on earth because you haven't suffered the drawdown of the recent past, and this is the time that you should go out and participate in what I call the great Diwali bumper sale, which is playing out. Can things get cheaper from here? Most certainly they can. Will they is something on which the jury is out. But if you're looking for capital preservation, if you're scared to get into equities and still want to have a little bit of the fun, then obviously there are stocks like ITC and TCS to buy. I think it's going to be many decades before which people will lose faith in these businesses. ITC is coming off 6-year lows in cigarette volumes. It's been continuously punished by, or I should say facing punitive taxes for the last 5 or 6 years, even during the GST transition. And it has come out, I think, with admirable, if not shining colors there, to be able to grow cigarette net revenues at 8-9% CAGR with pricing hikes. And if you are at 20% lower volumes than where you were in FY12, then I think such an FMCG business, if I can refer to the cigarette business as an FMCG business, is a very resilient business. And I think here on, perhaps the tax hikes are not going to be as harsh. For the last 2 quarters, successive quarters, ITC has delivered volume growth. For me, this is the greatest sign that tells me that ITC is bottoming out in terms of a P that is being given to it. While most FMCG companies are at 40x or 38x kind of 1 year forward or FY20 earnings multiples, ITC is available for 25, 26 times. I know it will trade at a discount, but this discount looks too broad, too wide for me. TCS has of course had a dream run on the markets over the last year and a half, but again TCS is also down some 15-20% from TCS has of course had a dream run on the markets over the last year and a half, but again TCS is also down some 15-20% from current highs, 15-odd%. And I think here the engine, so TCS is now a $20 billion company, the engine of growth is in no way threatened by all the funny noises that might be emanating from the US, especially on the policy or regulatory side. I think TCS has got its act right. They've got a very high share of digital in their business, which is growing much faster than the legacy business. Here is a management, despite despite managerial or CEO changes, has been consistent in how it's been driving the business. Over the last 2 or 3 years, TCS has ramped up utilization, managed the pyramid, grown into more countries, and held on to margins in a way that virtually no other IT company has done. It's the steadiest, rock solid performer that you can find in the Indian IT market. If you want to preserve your capital and get good value for money, today is the time to start accumulating TCS. You get it 10% cheaper, well, buy more. That's all I can say. So in terms of capital preservation, I think these two would be our top picks. Then there are, of course, mid-caps like Chola or Mindtree that I can recommend. But that's a different story. You need much more risk appetite there.